Hello, hi learners. Welcome back to CA Foundation Principles and Practice of Accounting Marathon Revision. We've so far done with 5 lectures in which we've revised 8 chapters of your syllabus. So this is the last part, lecture 6 of your CA Foundation Marathon Revision, in which we'll be doing chapter 9 and chapter 10. So without wasting much time, let's get going. And before I go ahead and then start financial statements of company, here I have some very important information to you all. There's going to be mega revision free test series conducted on Unacademy application on 15th of June at 2 p.m. for accounting, and 18th, 21st and 23rd it's scheduled for law, maths and economics, which you can definitely take up by spending 30 minutes and taking 20 MCQs. You can test your examination preparations and then understand how far have you gone in clearing this CA Foundation examination. Also coming up on this very Sunday, June 20th is CA Intermediate Mega Combat, taking up which will let you get huge discounts on your CA Intermediate subscription, which is a must-have right after your CA Foundation examinations. So what are you waiting for? Take up your phones today, download Unacademy application from your Play Store and then use the code YESHES to enroll yourself for CA Intermediate Mega Combat, also for Mega Revision Free Test Series. And you also know the CA Iconic program, the flagship model of Unacademy, which gives you great advantage of one-to-one personal coaching, one-to-one doubt solving, evaluated test series, hard copy of the material at your doorstep, sessions from industrial experts, and also you get to be part of Nord discussion channel for all your doubts. This is over and above the usual plus benefits of live interactive classes, recorded backup being available, unlimited number of views available to you, and with one subscription you get to access every educator who teaches CA Foundation and their notes. So take up your Unacademy subscription today. The price for taking up the subscription of Unacademy Iconic is this way. A 24-month subscription comes at a price of 41,000, a 12-month subscription comes at 28,600, and a 6-month subscription comes at 20,500. And you use the code YESHESLIVE and that gives you 10% discount on the price that you just see on the screen. So what are you waiting for? Take up subscription, use the code YESHESLIVE, avail 10% off and join us in letting us help you in the pursuing the dream of becoming a chartered accountant. You get this? Come on, let's now get back into the topic of financial statements of not-for-profit organization. So with regard to not-for-profit organization, the objective is not to make profit. It is a service oriented. It is basically an educational trust or an hospital or other form of organization where the objective is not to make profit but to render service to the people who basically need it. Got it? So here the objective is to work for a purpose, for a cause, promote a sport or an art form, or fight against a social enemy or help a community. As I mentioned to you, example can be a sports club, a dancers association, a hospital or an apartment association. You get this? So here, because the objective is not profit, the financial statements are going to be little different from how we usually prepare in the form of a sole proprietorship or any other form of organization. In this case, we are never going to identify or prepare P&L account. We're going to refer that to another form of an account called as income and expenditure account. You get this? And cash book will be renamed and called as receipts and payment account. And in this chapter, we will not be calling any amount as profit. We will be calling it as surplus. That surplus is excess of income over expense. If the incomes are more and expenses are less, it is called as surplus but not profit. And there is no term called loss in this chapter. It's going to be called as excess of expense over income. Expenses are little more than income. We call it loss or we call it deficit. Basically, we'll not be calling it loss. We'll be calling it deficit. And the balance sheet will remain as balance sheet and capital account will remain as capital fund. We will not be calling it capital, but we'll be calling it capital fund. And the entire chapter runs around the concept of accrual as to how do we maintain prepaid expense, outstanding expense and everything. This is the basic crux of the chapter. If you can decode this prepaid expense, outstanding expense, prepaid income, pre-received income and then accrued income, once you get this kind of concept right into your brain, and rest of the thing is same final accounts with different name. You guys get this? Remember this fact that with regard to a prepaid expense is an asset, meaning we have paid money but we have not taken the benefit. Such an asset will have opening balance on the debit side, closing balance on the credit side. And with regard to outstanding expense, which is a liability, opening balance will be on the credit side and closing balance would appear on the debit. Now going ahead to learn as to how does it work with regard to income, it's going to be opposite. With regard to an income, if it is pre-received income, if you received it before earning it, then it's going to be liability, and opening balance of pre-received income will be on the credit side, closing balance of pre-received income will be on the debit side. With regard to amount which is accrued, meaning you have earned but not received, that my friends is an asset. Opening balance of accrued income will come on the debit side, closing balance will come on the credit side. Do you get this? Now let's understand what sort of questions can come in the chapter of NPO. In the chapter of NPO, they can give tiny questions, a 4 marker, 6 marker, 8 marker question, wherein they ask you to prepare a simple specific expense account or a simple specific income account to identify how much is the expense received during the year or how much is the expense for the year, which should be transferred to income and expenditure. Similarly, a question can come on income and a question can come on income account, basically asking you to compute how much of income is received during the year or how much of income is receivable during the year or how much is the income for the year, which needs to be transferred to income and expenditure. In such a case, we'll prepare these ledgers. For an expense, we will write opening prepaid debit side, closing prepaid credit side, opening outstanding credit side, closing outstanding debit side, and we'll write the amount amount paid towards the expense if it is given. Find the income or expense for the year as balance figure. Or if they would have told you what is the expense for the year, we write the expense for the year and find the amount of payment made during the year for that expense as balance. Vice versa is going to work with income. How do we do it with regard to income? We'll write the pre-received income on the credit side, opening, closing pre-received on the debit, opening accrued on the debit, closing accrued on the credit. If they've given us income for the year, such income for the year we'll write on the debit side to find how much income is received during the year as balance figure. Or in an alternate scenario, if they give us how much is the income received during the year, we'll find out as to what is the income that should get transferred to income and expenditure account during the year. I hope you guys got this. Now, these are smaller questions. If you talk about big questions, the kind of questions from this chapter that can come are basically this way. Let me show it to you. I've made a list somewhere here. Yes, remember this. So there are 4 big things that come up in the chapter of NPO. 2 balance sheets, one is opening, the other one is closing. They would give us income and expenditure and receipts and payment. These 4 items will complete the set of accounts required with regard to an NPO. The questions can be, they can give you the previous year's balance sheet and receipts and payment account for previous year, ask us to prepare the income and expenditure account and balance sheet for the current year. Or instead they can give us the previous year balance sheet and the income and expenditure and ask us to prepare the receipts and payment and closing balance sheet. Or in a very rare scenario, they can give us both opening and closing balance sheet, ask us to prepare receipts and payment and income and expenditure, or they can give us receipts and payment and income and expenditure and require us to prepare both opening and closing balance sheets. These 2 scenarios are very rare. However, these first 2 scenarios what I mentioned are quite possible. In such a scenario, all that we need to do is read all the adjustments at first place, identify the adjustments which are affecting because of opening outstanding, closing outstanding, all of these. Okay, whatever items which have adjustments, make a marking next to them from the receipts and payment or income and expenditure account given in the question to us. Once you do that, check if opening balance sheet is already given or check if opening capital fund is given. If it is given, fantastic, you don't have to prepare opening balance sheet. If they have not given opening fund, then open closing balance sheet, opening balance sheet, and one of the receipts and payment or income and expenditure account, whatever is not given. Write that, read each of the transaction, see where it should be going and go on posting. Later read the adjustments, give the impact for the same and close one ledger after the other first, which you opened as working note. After you close that ledgers, post it to respective income and expenditure or receipts and payment. Then close the opening balance sheet, identify capital fund, post it to closing balance sheet. Closing balance of receipts and payment being closing cash balance, it will go to balance sheet. Closing balance in income and expenditure account, which is definitely our surplus or deficit, will go get adjusted with capital fund. And that's how my friends will close this entire chapter. It is easier said than done. I totally agree with you on this point. But this being marathon revision, I don't have sufficient time to do an entire problem on this topic and then share with you. But what I definitely did was I basically gave you an overview as how to deal with this. Yeah, the kind of adjustments that can come here is with regard to subscription account, wherein subscription account there are outstanding or accrued prepaid, pre-received for previous year. Like, oh sorry, subscription is basically income, isn't it? So it will be pre-received and accrued opening and closing balances given, along with sometimes they'll give you what is the current year subscription income, or sometimes they'll give amount received during the current year. Using this, you will find the missing item and then show its impact in the final accounts of NPO. So that's how the chapter of NPO work. There is not much of theory of NPO what I can spend and time and then make you understand in the marathon revision. It's going to be problem driven, but I've told you the crux of it and the kind of adjustments that can come. And with regard to certain items, it can be either treated as a revenue item or added to capital fund. Read the question cautiously because they would tell us in the question whether to treat it as revenue or to take it in the capital fund. If they mention nothing, if it is something like entrance fee or something, we can usually take it as income and expenditure item only and need not capitalize it unless they specifically tell us in the question. If in case there is still an element of confusion or lack of clarity, please do give a note and then say that in the absence of specific information, this is treated completely as revenue item or this is treated completely as capital item. Got it? Fantastic. That's with regard to NPO, my friends. Let's now quickly move on to the topic of company accounts. Shall we? Yes. So company accounts chapter awaiting you. And there I go with the topic of company accounts. Just a moment. Yes. So the last chapter of your CA Foundation Principles and Practice of Accounting, the topic of company accounts. So introduction part is only there in this chapter. It's not there in detail, but whatever is there here we'll definitely read because this will act as a very strong foundation for your CA intermediate examinations. Yeah. Okay. So let's get started. The important characteristic features of company is an incorporated association, voluntary in nature, having perpetual succession, limited liability, separate legal entity and transferability option. Yeah. So company wants a lot of money. Company can raise the money that it wants in two forms. In how many forms? In two forms. That is one, that is by way of capital or by way of loan. Whenever company raises money by way of capital, we call it share capital. Share capital can be classified into two major classifications. One is equity share capital, other one is preference share capital. Equity share capital is construed of equity shares, preference share capital is construed of preference shares. Before I tell you the difference between equity share and preference shares, let me first tell you what is share capital. Shall I? According to the definition given by Companies Act, Section 2, subsection 84, share means a share in the share capital. Share is a share in the share capital of the company. What is share capital? Among a big piece of cake called share capital, if you cut a small slice, that small slice is called as share. But if I put that small piece together and then when I call about the entire cake as a whole, that's what we call as share capital. A single unit of share capital is called as share, but all the share units together collectively they form share capital. Got it? Now let's quickly see what are the types of shares. There are two types of shares. One is equity, other one is preference. What is equity share? Equity share is a share which is not having preferential rights. If the share doesn't have any preferential rights, it is called as equity share. What is a preference share? Preference share is a share with preferential rights. If a share has preferential rights, then my friend we call it preference share. Did you guys get this? Now, preferential rights. What are preferential rights? Preferential rights are at the time of dividend and at the time of repayment. So preference shares will have preference at two times, one at the time of dividend and second one at the time of repayment. If in case the company is distributing dividend, all the shareholders are there standing in the queue waiting to collect dividend. The company will first pay dividend to all the preference shareholders. After the dividend is paid to preference shareholders, if there is any part of the profit that's still left out, using that the company will pay dividend to equity shareholders. And another important point is percentage of dividend to pay to preference shareholders is prefixed. At the time of issue of preference shares only, we will decide the rate of dividend that they are eligible to. Only if we have sufficient money left out after paying preference dividend, equity dividend will be given. Got it? Second point. At the time of winding up of the company will sell all its assets and then pay back the liabilities and then pay back capital. when the company comes to paying back the capital back to the shareholders, the preference here with the preference shareholders, meaning company has to first pay the money back to preference shareholders. After paying the entire money to preference shareholders, with what is left, you need to pay equity shareholders. If nothing is left, equity shareholders, my friend, I am sorry, is what the company will say. Do you get this? Fantastic. So that is the preference that preference shareholders have. That is the reason they're called as shares with preferential rights. And equity shareholders have no such preferential rights. That is the reason they're called as equity shares or shares with no preferential rights. Yes, I hope you understood. Let's get forward. What is share capital? I told you a single unit is called as share, but all the shares together collectively it's called as share capital. What is it? All the shares collectively form a pride? No, all the shares collectively is called as share capital. All the shares collectively is called as what? Share capital. Got it, guys? Fantastic. Now ask me how many types of share capital do we have? We have several types of share capital. What are the types of share capital that we have? We have authorized capital, issued capital, subscribed capital, called up capital, and paid up capital. What is authorized capital? Authorized capital, my friends, is the maximum limit what a company can raise. And this maximum limit is given by registrar of companies. Who gives this maximum limit? Registrar of companies. Let's quickly write this down. So what do you mean by authorized capital? Maximum limit that the company can raise by way of shares. Maximum limit prescribed. Who prescribes this? Prescribed by registrar of companies. Got it? The next one is issued share capital. What do we mean by issued share capital? It is that part of authorized capital which is issued by way of shares. By whom? By the company. Yeah, part of authorized share capital issued by company. Yeah, they need not issue the entire authorized capital. They can choose to issue only some part of it. Out of the part which is issued by the company, public have the option or the people have the option to subscribe to certain part of it. To the extent people subscribe, it is called as subscribed share capital. This is part of issued share capital subscribed by shareholders. Once they subscribe, there is no obligation on the company to ask for entire money on the share. Company can decide to ask for only part of such money on the share. When they ask for part of such money on the share and the company asks for such part of the money, that part what is called by the company is called as called up share capital. What is called up share capital? It is part of subscribed share capital called by company. You get this? So it is a part of subscribed share capital. What the company says, come, pay me the money to shareholders. That is called up capital. Okay, you have done your work of asking the money. Will they pay everything? It is good if they pay everything. If they don't pay, to the extent they pay, it's called as paid up. To the extent they don't pay, it will be called as unpaid capital or it will be called as calls in arrears. It is the kind of item which I maintain as a suspense till the end. But however, we're already doing marathon revision and I'm going to finish the rest of the syllabus in another 25-30 minutes. So I have no reason to hide it for long. I'll disclose it to you. So what is paid up share capital? Paid up share capital, my friends, is part of called up capital or called up share capital paid by the shareholders. Got it? To the extent it is not called, it is called as uncalled capital. Yeah, and to the extent it is unpaid, it's called as unpaid capital. Unpaid capital is that part of called up which is not paid. Uncalled capital is part of subscribed which is not called up. Yeah, this unpaid capital will become calls in arrears. Yeah, this uncalled capital will become reserve capital. Meaning they might either call it only at the time of winding up or they might call it in the process of business also. If they choose to call it only at the time of winding up, it will be called as reserve capital. Got it? These are the types of capital, very theory types. Let's go ahead and understand the next part. Is there a condition that the nominal value and share price should be same, or nominal value or issue price should be same? Need not be. Nominal value and issue price can be same, can be less, or can be more. If nominal value and issue price are same, it is called as par, issue of shares at par. However, if the shares are issued at a price greater, meaning the issue price is more and the nominal value is less, that is what we call as premium. That is what we call as issue of shares at premium. And if in case finally we have issued the shares where nominal value is more and issue price is less, we call it discount. What do we call it? Discount. Yeah. And issue of shares at discount is forbidden. Section 53 of Companies Act 2013 says shares cannot be issued at a price lesser than nominal value. You get this? Chalo, let's see this. What does the law say about it? Section 53 of Companies Act 2013. Ouch. Restricts issue of shares at discount. You are not allowed to issue shares at discount. You would have to issue it either at par or at premium. Got it? Fantastic. So there are two kinds of shareholders, what we call as bad shareholder and good shareholder. Who's a bad shareholder? Who doesn't pay money. Who doesn't pay call money. Company has called for money, no? If the shareholder doesn't pay it, we call it bad shareholder, or the name for it is calls in arrears. What is the name? You have asked for the money, but the shareholder has not paid. He's like, I'll give tomorrow, and he is not paying. What do you mean by a good shareholder? A good shareholder is a person who pays the money. Sir, everyone pays. He pays the money not when you call, but before you call only. Yeah, you ask for allotment money, he paid call money. You ask for first call money, he paid final call money. He told like, keep it, sir, keep it, keep it. Company, no, you keep it right now. You adjust it later. Don't ask me again. So he's a very good shareholder, isn't it? Yeah, pays money even before call. Before you ask only he'll pay. And such people are called as, or such people give rise to calls in advance. I hope you guys understood this part. Got it? So a bad shareholder gives rise to calls in arrears and a good shareholder gives rise to calls in advance. Calls in arrears is basically, calls in arrears is an asset to us. It is an asset. We have to receive money, no, against calls in arrears. So this is asset to company. You get this? Because as a company, you have not received money and you have a right to receive. However, calls in advance, when you collected money even before you ask for it, till the time you make such a call, that money is your liability. Why? You don't have a right to hold that money. He has given it to you in advance, so it is a liability to you. And this being advance, this being an asset, you, whenever you ask for money of calls in arrears, you can ask it with interest from the shareholder, because he didn't pay when you asked him to pay. He's paying late, you will ask him to pay me the principal of calls in arrears, also pay me what to say, interest on the same. You get this? So can be collected with interest, or interest is charged on the same. Interest is charged on calls in arrears, and this interest on calls in arrears is expense or income? This interest is our income. This interest is income. Do you guys get this? Why? We are charging that interest. No, we are supposed to receive, receiving late. So we charge him interest and we receive it. However, alternatively, on calls in advance, he is a good shareholder. He is paid us well in advance. To keep him happy, as a company, we pay interest. Yeah. Interest is paid on calls in advance. We pay interest on calls in advance. and that interest whatever we pay on calls in advance, no, is always my expense. Remember this, interest is expense. Got it? Interest on calls in advance paid by the company is expense. So what is the rate of interest? Simple. Who's big, company or the shareholder? Definitely company is big. When the company pays, company will pay more. Company will pay interest on calls in advance. Company will pay 12% per annum for the period of advance. However, when the shareholder has to pay interest to the company, he is a small person, he will pay 10% per annum. I hope you guys understood. So interest on calls in arrears is 10%. Interest on calls in advance is 12%. Company pays 12% interest on calls in advance and it is expense to company. Company receives interest at 10% on calls in arrears and this is income to the company. Got it? Fantastic. Going a little ahead. So this can be further analyzed. Now we did bad shareholder, good shareholder. Now we can analyze bad situation and good situation. Company can either be happy or sad. Now the question is, what can make the company happy? What can make the company sad? Company can be happy when applications received is greater than applications called for. When the company calls for applications of 1 lakh shares and the company receives 2 lakh applications, I can say that this is a happy scenario to company. Company has received more applications than what they called for. However, what is a sad situation? Sad situation is where company will receive lesser applications than what it called for. A scenario like company called for 1 lakh applications but they only got 80,000 applications. Company called for 1 lakh share applications but they received only 80,000. So where application received is lesser than applications called for. This, my friends, is what we call as a sad scenario. Literally, the company will be happy when it receives more shares applications than what it called for, and company will be sad whenever they receive less applications than what they called for. The technical name that we give for a happy scenario is oversubscription. What do we call it? Oversubscription. And the name that we give for company receiving lesser applications than what it called for is under subscription. It is called as under subscription. So in the case of oversubscription, they receive more applications than what they call. In the case of under subscription, company receives less applications than what they called for. In the case of under subscription, the company cannot go out for issue of shares unless and until there is minimum 90% subscription. So if the company calls for 1 lakh shares and they receive 95,000 applications, which is 95%, company can go ahead with the issue, allot the shares. However, if the applications are received is less than 90,000, when the applications called for is 1 lakh, company cannot go ahead with the issue of shares. It has to cancel the entire issue, refund the application money that is just already collected. Got it? That's how we deal with sad scenario. Yeah, let me write that. So I use the words here. No, what is it? It is over subscription and under subscription. Now, how are we going to deal with over subscription and under subscription? That's what I'm going to discuss right now. Shall I get started? Now, with regard to under subscription, what did I tell? Minimum 90% should be subscribed. 90% shares should be subscribed. If there is no minimum 90% subscription, what do we do? If not, reject applications and refund money. Not what do? We reject the applications and refund the money back to the shareholders. This is what we do under subscription. In the case of over subscription, the company has two options. Number one, either it can go by lot system, yeah, pick allotment by lottery. Now, if you received more applications than what you called for, then you can either go by lottery system, mix of all the applications, pick the applications and then allot them the shares. You can do this lottery or you can go for pro rata. Pro rata is what? Proportional allotment. If someone has applied for 10 shares, you give them 2 shares. If someone has applied for 20 shares, you give them 4. Someone has applied for 25 shares, you give them 5. So you do proportionately lesser number of shares allotment to the applicants when they had applied for a bigger number. This way we will satisfy all the applicants and then give them shares and ensure that we are not allotting more shares than what we initially offered. In no case can the company accept all the applications and then allot more shares than what they called for. Maximum allotment is limited to the amount that is called for. You can't go beyond that. You get that? Yes. So that's the point of oversubscription, undersubscription. This point of oversubscription is actually connected to our calls in advance. How? In the case of oversubscription, company would have received more applications than what they called for. They would have collected excess money. If in this case the company goes into pro rata allotment, then what the company does is, against the application that is excessively received by the company, they would have to refund the money back to them. They would have to refund and again ask allotment money from them. Instead, what the company does is, against that excess shares which are not allotted, the money which is collected towards application will be retained by the company and adjusted against allotment or call. Such money what is kept with the company, which should have been refunded in an alternate scenario, is the amount of calls in advance. Do you guys get this? We do a very detailed discussion on this very point in our regular class, but considering that this is a fast track revision, I would have to run you through this in a super quick time. You guys get this? So don't judge that, is this the way it's been taught in the regular course? No, the regular course would run at a different trajectory or different kind all by itself. Yeah? No comparison of this marathon revision to regular class. Marathon revision is super quick. Regular class will go soft, smooth. Every topic may we do problem, every topic may we take example, every topic may we write notes. Get that? If you have attended my regular batch, you would know it by now. If not, this is just for information. Yeah. Chalo, let's get going. Next up, let's get going ahead and then see how do we treat these bad shareholders. I mean, treatment of calls in arrears. Whenever there are people who don't pay us money, what we have asked them to pay, we give them enough opportunities, we give them notice and ask them to pay. If they don't pay, even after multiple notice, what do? We go ahead and then forfeit the share. What do? Forfeit the share. I'm going to type it in red. Let's see if it will come. We're going to do forfeiture and reissue of such shares. What are we going to do? I'll write it here. I don't know if it will look good or if it will be even visible on this thing. So I'm writing it in here. So we're going to forfeit and then reissue the share. What do you mean by forfeiture? Forfeiture is like snatching that share from the old shareholder because he is not paying us the money that we asked for. You get this? Once we snatch that share back, what do we do with this share? Obviously, we will not keep it with us. We will reissue to another person who's willing to pay us money. At the time of reissue, it can be reissued either at par. Let me see, is it visible? I think it's okay. It is visible. Or it can be issued at premium, or it can be issued at discount. Sir, you told some time ago that shares cannot be issued at discount. Yeah, shares cannot be issued at discount. That thumb rule is still upheld. It will be reissued at discount, and in spite of reissue, it is ensured that together from the old shareholder as well as the new shareholder collectively, you have received your nominal value. Meaning, you are allowed to give discount to the shareholder on reissue. However, such amount of discount on reissue cannot exceed the amount that was previously collected. Didn't understand? Let me explain this to you. There is a share of rupees 10 against which entire 10 rupees is called. But the old shareholder paid us 8 rupees. Old shareholder paid 8 rupees. 2 rupees is the final call which was made and the shareholder didn't pay. Let me repeat. There is a share of rupees 10 fully called up, entire 10. Old shareholder has paid rupees 8 but he failed to pay 2 rupees. Now when he has not paid the 2 rupees, you give him multiple notice, multiple warnings, he doesn't pay, so you forfeit the share, you take that share back. Now when you reissue this share, you don't have to reissue it at a minimum price of 10. You have to reissue it at a minimum price to cover up the nominal value. In the nominal value of 10, 8 is already collected. So minimum reissue price is 2 rupees. Got it? What is minimum reissue price? 2 rupees. If any shareholder is willing to pay you 2 rupees, that's more than sufficient. If you collect more than 2, it is profit on reissue. You get this? However, you cannot reissue it at a price lesser than 2. Why? You have collected 8 rupees from the old shareholder. If you collect 2 from the new shareholder, together it becomes 10. Nominal value covered. So that's what we can do. You get this? So discount. Maximum discount is limited to share forfeiture account. So maximum discount is limited to the amount available in share forfeiture. Sir, why do we write maximum discount being limited to amount in share forfeiture? Because share forfeiture account has the balance which is paid by the previous shareholder. Whatever the money previous shareholder pays, no, that we would have transferred to share forfeiture account. So we say that the maximum discount is limited to amount available in share forfeiture. You guys get this? In our example of a 10 rupees share which is fully called up, 8 was paid by the old shareholder. So maximum discount I can give is 8. Excuse me, sorry. If in case I collect any amount, maximum discount I can give is 8. So minimum issue price is 2. If I collect 3 rupees on that share, meaning I issued 7% 7 rupees discount, then 8 rupees collected from old shareholder, 3 rupees collected on reissue. So 8 plus 3, totally I have collected how much? 11. Nominal value is 10. So for a 10 rupee share I have collected 11. That 1 rupee what I have collected extra is profit. And this profit will be transferred to capital reserve. Got it? I'll show this to you when I start showing you the accounting entry. What we need to do on forfeiture is we need to do this working note, computing amount called up, amount paid up and amount unpaid. With regard to amount called up, we are going to debit share forfeiture account, share capital account. In the entry that we are passing for forfeiture of shares, with regard to amount paid up, we are going to credit share forfeiture account. This much money is previously collected and such amount represents our profit temporarily halted in share forfeiture account. If such profit is realized, it will get transferred to capital reserve. And amount unpaid would be the balance in our share allotment account, share call account or call scenarios. We will reverse that. Share allotment. If you have not transferred to call scenarios, it will be there in share allotment only or share call, or we will also transfer it to calls in arrears account. We'll transfer it to one of these accounts. Got it, everyone? Yes. I hope you guys understood this. This shouldn't be very difficult. This is the entry for forfeiture. Then we'll have the entry for reissue. Whenever we go ahead with reissue of forfeited shares, we'll write bank account debit. This is for the amount received, and if there is any discount, it will be debited to share forfeiture account. This is for discount on reissue, and then the credit will be given to obviously share capital. Like I mentioned here, if there is any discount on reissue, it will be debited to share forfeiture account. Got it? Or there can be some premium also, no, on reissue. If there is premium, that will obviously go to security premium account. Yeah, if any. You get this? The next point is when is it premium and when is it profit on reissue? I'm going to explain this part to you. In our Excel, I have a detailed, we did a very big problem on this, and then to make understand, I've given you all the possible scenarios and then I've done that. Let me show that to you. Give me a moment. I'm finding it. See this. So this is a beautiful case which will explain the entire scene to you. The nominal value of a share is 10, out of which 3 rupees is application, 1 rupee is allotment, call is 6 rupees. So you have received your application and allotment money 4 rupees. 6 rupees call money was not received. So you went on to do forfeiture and you reissue. I'll tell you different reissue prices, and each of the cases will identify whether is it premium or profit. Yeah, if the reissue price is 10, what we need to remember is from the previous shareholder you have collected 4 rupees. Now from the new shareholder you collected 10 rupees. Totally you collected 14. 14 rupees is collected against a share of rupees 10. So 4 rupees is profit, and this amount reissue is allowed here. Yeah, because you collected 10 rupees. Similarly, if you reissue it at 12, old shareholders have collected 4, new shareholders have collected, old shareholders have collected 4, new shareholders have 12. Together you collected 16, which is more than nominal value. So reissue is allowed here also. If you reissue it at 9, old shareholders have collected 4, new shareholders have collected 9, together you collected 13, nominal value is 10, reissue is allowed. Reissue is not allowed only in one case, where the old shareholders have collected 4, reissue price is 5, so total collection is 9, but the nominal value is 10. In this case, it is not allowed. In other cases, it is definitely allowed. Now, let us see and identify how to go about and then compute our profit or loss on this. And there is another logic that I told now. Reissue price is 10. Yeah, nominal value is 10 and the discount allowed is 0. That's fine. From the old shareholder you have collected 6 rupees, isn't it? So the maximum discount possible is 4. If the discount is more than 4, then the reissue is not allowed. If you issue the share at 10 or 12, it is par and premium. There is no discount. If you issue the share at 9, there is 1 rupee discount, which is well below maximum discount of 4 allowed. If you reissue it at 7 rupees, it is discount of 3, which is below 4 rupees maximum discount allowed. Reissue is still allowed. If you reissue it at 6 rupees, it means that there is 4 rupees discount, which is equal to the maximum amount of discount that can be allowed. Reissue is still allowed. However, if you go on to reissue it at 5, which makes the discount allowed become 5 rupees, which is more than the maximum discount allowable 0.4. So the reissue is not allowed in this case. Got it? Now let's see how to determine the profit or loss on this. Same scene, nominal value 10, amount called up 10, amount paid up 7, calls in arrears is 3. 7 rupees is received, 3 rupees is not received, then you go for forfeiture. If you reissue it at 10 rupees, previously collected 7, now collected 10. Together you collected 17 rupees against a share of rupees 10. So 7 rupees what you collected extra is profit. So entire amount is profit. Sir, when will it be premium? It will be premium when the reissue price exceeds nominal value. Look at the second scenario. Reissue price is 12. When the reissue price is 12, 12 is greater than 10 rupees nominal value. So the 2 rupees extra collected is straight away premium. However, after the 2 rupees, you collected 10 rupees towards the share from the new shareholder, 7 rupees from the old shareholder. Totally, you collected 17 rupees, but nominal value is 10 only. That excess money what you collected of 7 will become our profit. Oh, this is not 9. Sorry, this is 7. Correct, no? 10 में 2 rupees is premium. 10 plus 7. 17 minus 10. This is 7. Sorry. This is 7. And in the other scenarios, again, the concept would become basically the same thing. So 9 rupees is the reissue price. On reissue, you collected 9. From the old shareholder, you collected 7. Totally, you collected 16 rupees, which is in excess of 10 by 6. That is your profit. Is there any premium? No. Why? Reissue price is 9, which is well below the nominal value of 10. A similar thing is done for quite a lot of other adjustments also. You can look into this. You will understand it better. You got it? I'll pause this for a moment so that you can take a screenshot if you want of this particular point and revise it at a later stage. Hoping that you're done with this. Now I'll move a little ahead and take you guys ahead in the concept. Yeah, when is it premium on reissue? When is it profit? When is it premium? When reissue price is greater than nominal value. When reissue price is greater than nominal value, we call it premium on reissue. We call it premium on reissue. When is it profit? When reissue price excluding premium plus collection from old shareholder is greater than nominal value of share. We'll put it up here. We'll put here it's profit on reissue when reissue price excluding premium plus collection from old shareholder is greater than nominal value. Here it's premium on reissue when it's called as premium on reissue when reissue price is greater than nominal value. I hope you understood. What is the treatment of profit on reissue? If there is any profit on reissue, it will be transferred to capital reserve. It will be transferred to capital reserve. Got this, guys? This is how we account for shares. Now let me quickly take you to debentures and then help you understand how do we account for debentures. And that, my friends, is the last part of this chapter. Got it? What are debentures? Debentures are acknowledgement of debt. Whenever the company takes public debt, company will give an acknowledgement in writing that yes, I've acquired money from these people by way of debt. Such an acknowledgement given by the company is called as debentures. There are several types of debentures which are like fixed debentures, secured debentures, I mean say debentures with secured charge or fixed charge or floating debentures. Convertible debentures which will get converted to equity shares and non-convertible debentures which will not get converted to equity shares. There is first debentures, second debentures. First debentures have primary charge or first charge. Second debentures have secondary charge or their rights are after the settlement of first debentures claims. So such is the types which is not very important. You guys can read it from the material, and that's something with regard to debentures. And what you need to remember with regard to debentures is debentures, unlike equity shares, can be issued at par, premium, discount. All the three are possible with regard to debentures. You get this? And further, debentures can be redeemed at par, premium, discount. Debentures can be issued at par, premium, discount, and they can also be redeemed at par, premium as well as discount. And whenever we issue the debentures at discount, obviously you would agree with me that it is loss, isn't it? Because we don't collect such money from debenture holders. Redemption is repayment of loan, and if in case at the time of redemption, if we pay premium, sorry, I marked par. If in case we pay premium that is more than what we collected, that again, my friends, is loss. So when we collect, if we collect less, it is loss. When we pay, if we pay more, it is loss. So loss on issue of debentures. Loss on issue of debentures is discount on issue plus premium on redemption. This is the total amount of loss. You can say, sir, loss on issue will include both, but at the time of issue, you should only account for discount on issue. No. At the time of issue, we need to make provision for premium that you need to pay at the time of redemption as well. Why? Because of conservative approach. So we need to make provision and then treat this entire loss as expense. We need to provide for both discount on issue as well as premium on redemption. This entire amount of loss on issue of debentures has to be provided for by debiting our P&L account. It has to be provided for by debiting our P&L account. Got it? Now, how do we debit our P&L account, or how do we provide for the same? It depends upon the redemption schedule. Yeah, treatment of loss on issue of debentures. What do we do? It has to be debited to P&L account over the debenture term. Over the debenture term, we write off this premium on redemption of debentures, or loss on issue of debentures. Sorry, the discount on issue of debentures. How? Yeah, how much? Debit to P&L every year. How much should we debit to P&L every year? This depends on debenture. This depends upon the debenture redemption schedule. Possible scenarios: if debentures are redeemed in lump sum at the end of 13 years, then what do we do? If the debentures are redeemed in lump sum at the end of 30 years, at the end of 5 years, you are going to redeem all the debentures. Then the debenture money is there for entire 5 years. Then the total loss on issue of debentures should be divided equally for every year during the debenture redemption term. You get this? So equal amount is transferred to P&L during every year of debentures being there in the company. However, if debentures are redeemed at the end of every year, if you are redeeming certain portion of debentures every year, for instance, a company has 10,000 debentures issued, they are not going to redeem entire 10,000 debentures at the end of year 5. They will redeem 2,000 debentures at the end of year 1, another 2,000 at the end of year 2, another 2,000 at the end of year 3, another 2,000 at the end of year 4. So first year there is 10,000 debentures, second year there is 8, 6, 4, 2, 0. So it's going on reducing. Then what do we do? Then amount to be transferred to P&L is determined based on outstanding debenture ratio. Outstanding debenture ratio at the beginning. Each year. You get this? At the beginning of each year, we identify how many debentures are outstanding. First year, 10,000 debentures. Second year, 8,000. Third year, 6, 4, and then 2. So we identify the ratio as 5:4:3:2:1. And in this ratio, we write off the entire loss on issue of debentures. Got it? I can show you a small example of this in one of the problems that we've solved in our class. This is from the regular batch material. Yeah, these are regular ones, are issue entries. I hope you understand that. See this. So debentures in this case, no, for 4 years, 6, 7, 8, 9. At the beginning it is 10,000. Redemption during the year is 0. So all the debentures 10,000 is redeemed at the end of year 4. So the total loss of 60,000 loss on issue of debentures is written off every year 15, 15, 15, 15, 15. 15 by 60,000 by 4. However, in an alternate scenario, if 2,000 debentures were redeemed here, 2,000 here, and 2,000 here, closing value will differ. And then if the closing differs, next year's opening value will differ, and the amount transferred to every year will be reducing in nature. Got it? I can show you one problem of that sort also. Here 6, 7, 8, 9, 10 are the years. At the beginning of the year there is 10,000 debentures. 2,000 is redeemed during the year. The closing is 8. Next year my opening will become 8. 2,000 is redeemed. Closing is 6. Third year opening is 6. 2 redeemed 4. Fourth year opening is 4. Redeemed 2. Closing is 2. 2, 2, 0. So now the opening ratio is 10 is to 8 is to 6 is to 4 is to 2, which is 5 is to 4 is to 3 is to 2 is to 1. Total loss on issue of debentures is 60,000. This is written off in the ratio 5 is to 4 is to 3 is to 2 is to 1 over the 5 years period of debentures. Got it? This, my friends, is how to deal with debentures. With this, we've also royally covered the topic of issue of debentures. Well, let me tell you what I've not covered up in this entire topic is one teeny tiny topic of the journal entries that should be written at the time of issue of shares, which I forgot to cover. So I'll tell you it right now. There can be multiple stages at which the money can be collected by the company. We call it application, allotment, and call. Money is received from the company towards application and then it is transferred to share capital. So first we'll write cash account debit to share application, cash account debit to share application. Yeah, and then from share application it gets transferred to share capital. So then we'll write share capital account, share application debit to share capital. However, on allotment, first you call for money and write the entry share allotment to share capital. Then you receive the money bank account debit to share allotment. Same repeats with regard to call stage. However, we've covered the topic of calls in advance, calls in arrears, interest on calls in advance, interest on calls in arrears, forfeiture, and quite a lot of other things. I hope this entire set of marathon revision, whatever was discussed, was of some help to you people in your exam preparations. Yeah, this is definitely not the only thing that you need in exam preparation. Well, what I did in this marathon revision is covered the concepts using which you can solve some problems right after this marathon revision, because you have another week's time left before the exam and you can do really well in the examination. That's the intention behind this entire marathon. I hope it was helpful. It is about 12:30 now in the night. After I took a 10-hour class this morning, I came back to record this last part because I wanted to live up to the promise that I made to all of you people of making the marathon revision available for this very attempt. Got it? So my only point of doing all of this is hoping that you all clear off your CA foundation and get into CA intermediate and then meet me again. My prayers are always there with you, hoping you to succeed in this exam. So that's it. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you guys are learning something, you're having fun, it's all good. The day you either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. The thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question to all of you. Are we in the game? I hope your answer is yes, we are in the game. Please don't forget to like, share, and then comment on this video. Please do tell me as to how beneficial was this in your examination preparation, and also share it with your fellow students or fellow friends who are preparing for CA Foundation examination. Got it, guys? So all the best in your examination preparations and do really well in the exams. See you all in CA Intermediate. Till then, tata, bye bye, take care, stay in the game and get lost. Bye, guys.